Good morning, good afternoon, and good evening. Now that you're here, you're going to learn the agenda of the market makers. You're going to learn how the algorithm that they use operates in the Forex market. The agenda of this algorithm is to engineer liquidity and grab liquidity. So let's begin. I also have this very simple indicator that is going to prove exactly what I mean in the next few minutes. Watch to the very end. Let's proceed. So the indicator which you need to put on your charts is called daily high low. So you go into the indicator section, you type daily high / low. It's by Unknown Unicorn. He has approximately 2,190 downloads. So you download that. Once you download it, go to settings, pause your screens, pause the video and copy the settings. As you can see right here, I have cross, I have a thin line, everything is marked out, inputs, show on charts, so nothing complicated right there. So what does this indicator do? Very important. Each day there's a high and there's a low. The day creates highs and the lows every single day. On my chart I have session breaks. How do you put it? So each of these lines is a session break. All you need to do to get that is go to this section over here and click session breaks. These 10 lines right here, they separate each day, 10 p.m. to 10 p.m. Okay, then each day there's a high and there's a low. So for instance, the highs and lows of this day is this box. So what I really like about this indicator is that it inputs the low of this day into the new day. So as you can see, this dotted line is in the new day, and it does the same thing for the high. This is the high of this day, and it inputs the high of this day into the next day. For smart money traders, that's very important because we understand that the agenda of the market makers is to engineer price and grab liquidity. And this indicator is going to open your eyes to how the price and the market actually operates, especially in ranging markets. Watch to the very end. So now that we know what this indicator does, and it's very simple, it inputs the highs and the lows of each day into a new day. Okay, so you can see this is the low, this is the high, and it inputs it into the future. As a matter of fact, so that everybody can see this clearly, I'm going to make these lines bigger. Right there. So now you can see it much clearer. So whenever there's a high and whenever there's a low, there are people all over the world that place their orders, their sell stops, buy stops, sell limits, all of that through their brokers. In each of these orders, they put their money down, $100, $1,000, $10,000. Okay, so as they're placing these orders, now the banks who control these algorithms, the banks, the big banks, they're the ones who are making the market so liquid. Okay, the reason why retail traders can make money is because of the big banks. Okay, because the liquidity is provided by them. So they pump a lot of money into the Forex market so that they can make even more money from the Forex market. Okay, so we are participating in this game which they basically control. Retail traders make a very small proportion of the volume within the Forex market. So whenever the price gets engineered, okay, and you can see this highs and this lows, before the price goes in the direction which the bank has already decided, it goes the other way. It goes the other way and it takes out the liquidity from the previous day. So let me illustrate this very clearly. So once again, this is the high and the low of this day, and this indicator has inputted the high and the low into the new day. But let's just say we are trading on this day. What does the market do? The market first grabs all the stop losses. So if you're familiar with TradingView, you know that this is our short position. Short position is what you use to place your trades in order to control your risk management. Let's just say there are many people around the world who have placed their stop losses around this level over here. So these are the stop losses. Hedge funds, retail traders, small banks are all betting that the market is actually going to go lower, just like so. Okay, so they're not necessarily wrong. Okay, however, big banks have algorithms that know where the liquidity is resting within the forex market, and what did they do? They push the price higher than where the stop losses are, and then push the price to the downside. As you can see, this is not an accident. It happens day in and day out. This is also part of the reason why you may think that whenever you put your stop loss, you keep getting stopped out, keep getting stopped out, keep getting stopped out. If you don't have a verified strategy and you don't understand this, then this can really be a downer to your psychological mindset. So you need to understand that this is what happens in the forex market. Okay, so that's just one day. We can go through so many days, and it happens so frequently. So once again, right here, this is the high and the low. Okay, this indicator puts the high into the new day and the low into the new day. So we are trading on this day right here. This is the day when we want to place our trades. Okay, so what does the price do? The price consolidates for a little bit, takes out the high of the previous day, and then drops. Here's another example. This is day low. This is day high. Day low and day high. Now pay attention to what the price does. It's not an accident. You can see that the price, before going to the upside, takes out the swing low of this day, the lowest point of this day, and then goes up. This is the agenda of the market makers. This market makers have an algorithm, and this algorithm hunts your stop losses. It hunts the areas in the market where there is the most liquidity. What do I mean by the most liquidity? By the most liquidity, I mean that the areas in the market where a lot of people, a lot of institutions have placed their money. Wherever there's a strong swing high or a swing low, that's where people have placed their money. And in order for the market makers, in order for these huge institutions with deep pockets to make even more money, they have to take an opposite side. They have to engineer the price. So whilst they're engineering the price, you're making money. But at some point, they have to go against you, and they know exactly where people place their stop losses. They know exactly where people place their money, and they take it. So what do? With this indicator, you just wait for the liquidity to be grabbed. You wait for the stop loss to occur before you place your entry, backed by an order block or a supply or demand level. All this indicator does is just shows you the highs and the lows. So if the price is trending upwards, then the price is just going to keep validating the bias. You know, the price is going upwards. However, in ranging markets, when the price ranges, then it happens quite more frequently. So make sure you study this concept. I'll give you another example. This is the high, this is the low. In the new day, on our AED/JPY currency pair, the price does what? It goes to the upside. This is called a fake out, grabbing all the liquidity that was resting above these levels. Let's mark it out for you to see. Okay, these two swing points right there, but at the same time here we have a supply zone. So what does the market do? The market first grabs liquidity from these 2 points, goes into the supply zone, and then goes down. Now the market was from this point on, the market makers already understood that they're going to push the price to the south. But before they did that, what did? They grabbed liquidity from this level and from that level. And if you don't know that this happens all the time, you may be wondering, why do I keep getting stopped out? Once again, the algorithm, the agenda of the market makers is to engineer price. Whilst they're engineering price, retail traders can make their money. You can make your money. You can make your millions. But at some point, the price is going to go against your position. This is part of the reason why I enter the market, hold my position for a few hours and I'm out. Because if you hold it through the night, at some point there will be some sort of a fake out, liquidity grab, or a stop hunt. Let's go through a few more examples. See that this is the high of this day and this is the low. We are in between these two lines, 10 p.m., 10 p.m. This is the highest point of the day and that's the lowest point of the day. The indicator has inputted the high and the low of the day into the new day. This is what these two lines are. So wherever you see here, these two lines actually are showing you what happened yesterday, because the algorithm grabs liquidity from what happened in the previous day. This is the swing low and the swing high. Okay, so in the new day, the price first grabs the liquidity from the swing low, then the swing high, then drops. Traders all over the world have been seeing this concept happen all the time, and this is the reason why smart money was birthed. The reason why people started using the smart money concept, because it is a concept, is because they were seeing that the liquidity and the highs and the lows of each day, each week, and each month gets grabbed by the price action. So they came up with a concept called smart money in order to capitalize on this phenomenon. So there you have it. The two agendas of the algorithm that the market makers use is to engineer price, and whilst they're engineering price and people are placing their money into the price action, into the Forex market, go against their positions in order to make even more money for themselves. If you want to learn how to do this, send me a message. Subscribe to this channel, like this video. I'm currently working on a course, and in January I'm going to open up some slots for one-on-one sessions, for one-on-one mentoring. If you're interested, leave me a comment in the comment section below, and I'll see you guys in the next one. Blessings.